Mhm.
Here we go. The recording started, and let's see what we have here on those slides. Here we go. That's the new book from this year,
Oh, okay.
right?
Mm-hmm.
So what are the steps here? First, we have to determine the net income, right? And then we have to, by reconciling the accounting income to the income for tax purposes, then we have to determine the taxable income, which is for the individuals, they're allowed for some deductions where the corporation can deduct donations. And the individual, that's for individuals. So let's stay with the corporations. And after that, we're going to have to determine the federal tax payables, which will apply the flat rate of 38%. So you have to understand, always 38% apply flat rate. After that, you may have that additional flat rate for the Canadian Control Private Corporation on the investment income. Only on the investment income. That will be additional tax on the investment income. That is refundable, and the corporation are not subject to income tax rates like individual. There's no scale here on the small income, high income, anything like that. There's no, the individual, they have based on this income, that will be the rate, and based on that income, that will be the rate. Corporation, it's a flat rate. It's 38%, and that's all. Now, in the step 4, we're going to determine if there's any special federal tax deductions, which might be the small business deduction. It might be manufacturing processing profits deductions, general trade reduction, and if there's some federal abatement. And then we're going to apply the corporate tax, which is identifying based on the corporation and the income, which is categorized. Now, here we're coming to the small business deductions, which are allowed. Canada Revenue allowed that deduction against the federal income tax payable on the active business income. So you have to understand, first we have to chase, is the corporation Canadian Control Private Corporation? And if it's the Canadian Control Private Corporation, how much comes from the active business income?
I have a question. What's the
Yes.
difference between active business income and passive investment income?
It's a huge. Active business income is the one that's the corporation generates on the normal operating cycle of the company,
Oh, okay.
right?
Mm,
So
yeah.
technically you open company for business purposes, right?
Mm-hmm.
So you're gonna have a different type of incomes. Obviously, in the beginning
Mm-hmm.
in the company, you're gonna through the operations of the company,
Mm-hmm.
actively operating, you're gonna earn some income. That's
Okay.
called active business income.
All right.
Now, once you generate some income and you retain it in the company, then you can start investing on behalf of the company,
Mm,
right? And that will be different source of income, which is not related to the normal business operation of the corporation, right?
okay.
That will be that passive income,
Okay, I see.
right?
Mm.
So the maximum deduction here is 90% up to $500,000. So where we are now, we have the general rate, which is 38%, right?
Mm-hmm.
Minus we have the small business deductions. CBD, they usually is going to give it that CBD, but it's small business deduction, minus 19%. Then you're going to have this manufacturing and processing profit deduction. And that will be the maximum of 13%. Another 13% you have available to deduct. But this is only and only if your income comes from the manufacturing and processing. and less any of those profits which are eligible for small business deductions. So if it's eligible for small business deductions, you take it away, and then you're applying this 30% on the rest, which is only for the manufacturing and processing. Now the general rate reduction that apply for the taxable income that's not eligible for the preferential treatment. So you may have income which on which you cannot deduct a small business deduction or manufacturing and processing, or it's not refundable treatment on the certain investment income. So the maximum deduction here is another 13%. So imagine if I'm a manufacturing company, I can use the 13%. If I'm non-manufacturing company, I can use the general rate reduction. And still going to get 13%, right? Make sense? In both cases, if I'm a manufacturing processing company, I can use those 13%. If I'm not, I still can use it, but I can use the general rate reduction. With the general rate reduction, is not available for the manufacturing and processing company.
Oh, okay.
Right? So there's in both scenarios, you're getting 13% reduction. And then you have this federal abatement, which is 10% reduction on the income based on the proportion of the corporate tax income earned in Canada. Now we have to chase what's the income which you earn in Canada. So example would be if the 70% of the income is earned in Canada, reduction will be 7.5 because 10% will apply only to 75% of the income. So that's how they come up with that 7.5%. Let's do the example here. For the year ending December 31st, this company has 1 million taxable income, which has the follows. They have 900,000 non-manufacturing business income, 100,000 investment income. Company did not receive any taxable dividend income, nor there were any capital gain or losses. And also, it's not associated with any other companies. So, how are we going to deal with this? You know what? Let's get this example. And let's create something like an Excel spreadsheet. I don't know why I prefer Excel spreadsheet. You know what I mean?
Yeah, I mean, it illustrates better on Excel when you
And you can,
lecture.
yeah, and you can manipulate it, and you can do adjustments, and you can use it after for the other purposes.
Yeah.
And let's get this here, which is also Excel. Just give me a second. I'm gonna format this, and I'm gonna share my screen. Okay, almost there. Okay, I think I got something going on. Let me see the bottom part. Let's get this one too. And then we can have both, and we can just easily move it from one to another. Okay, question is here, the solution is here. Now we can look at the solution and look at the question and find out which one comes from where. And how exactly they come up with all those things. Okay, share my screen. Stop sharing this and move to the Excel spreadsheet. Okay, that's the host question with the scenario. Not that one. So our question was like this. No, come on. Sorry, a little technical difficulties here on the pasting. I wanted the question to be in the format that I can easily move it left to right rather than sitting. Here you go. Now I can move it left to right and work on it. Okay, we're done. So this is the example. The year end December 31st. So our starting point will be $100,000. So for that reason, 1 million. Sorry, 1 million. For that reason, let's make it more practical here, and let's start with here. We have $1 million. Right, the $1 million is given. $1 million. We have it, and we have the 38% tax rate. Then on the investment income, which is 100,000, we're gonna apply the 10.23%, 2 divided by 3. How are we gonna go do this? And that will be equal to 10 times 2 divided by 3. No, that's 10 2/3, right? 10, so it's gonna be 10 plus 2/3, right?
Yeah.
That's something like this. And this also will be percentage here. And that will be divided by 100 to come up with that. That will be a way better. And we can even show it. 1067. Okay. Then we're gonna have on the federal tax abatement on the entire amount on the active business on the 1 million. We're gonna have the 10%. 10%. Then we're gonna have on the small business deduction will be only on the 500,000. And that will be 19% on that one. And then we're gonna have 13%, but that will be on the amount, which will be the entire income minus small business deduction minus the investment income. So that will be equal to the entire income here minus the small business deduction that we're taking and minus the additional investment income which we carry. Only on the $400,000 we're going to get 13%.
We apply GRR because it's a non-manufacturing. Okay.
Yes, that will be the general reduction rate. So the other thing that we're gonna do here is, you know what? I don't like this abbreviation. I don't know how you feel about the abbreviation, but I generally don't like them. For that reason, let's make it clear what is what. Make sense?
Yep.
That way we're gonna avoid that this, what was that abbreviation for, what was this the abbreviation for, which is very, very, very annoying for me if I have to be honest with you.
Mhm.
So now we have proper formatting here. The only thing is we can, let's format using this format and format everything here. Okay. So that's our calculation. That's how we get those amounts. So
Mhm.
now this amount we can disappear and we can delete this. We don't need this one.
Oh.
And now what we're gonna do is we're gonna apply the formula this one time that one. And next time when you're going over this, you can easily use the calculation, right?
Mhm.
So the whole point is we to come up with something that will be more useful for you. So next time when you have to do something, you can easily get the results.
Mhm.
One more thing I'm gonna do is paste this one here, and then I'm gonna format those cells to match that same formatting. So now what we have to do is here we have to put something more interesting that will be less federal tax abatement, right? If we have to be technically correct, that will be less small
Mhm.
business deductions
Mhm.
and less general rate reduction.
Mhm.
Now it's going to make more sense, the entire scenario.
Mhm.
And now we know which one is the right one. I want to grab this one and format those cells as well. Obviously they all disappeared, and then we're going to do this percentage here, and we're going to have our percentages. Percentages, we need a little bit more zeros, and there we go. That's our formatting is fine. Okay, so now we have everything, right? So we know which one to add, which one to deduct. So the basic taxes in our
Yeah.
case will be 380,000 plus
Yeah.
additional. We have to add
Mhm.
this additional
Investment
income
income.
tax, and we can insert some space here
Mhm.
to get the total, some total in the middle, which will be those two together.
Mhm.
And then we're going to start the deductions.
Mhm.
And we can get here total deductions, total amount to deduct, which will be, right, that one. And then we can get our calculation to be this amount minus that amount, and we should get exactly the same number.
Mhm.
Make sense?
Yeah.
No, I get the wrong one. Trying to make it perfect so it can be easy for you to understand.
Yeah.
So
Yeah.
technically I don't need this one anymore.
Mhm.
So this is how you're going to calculate the taxes. So next time when you have a question, you
Yeah.
can easily come here and to see which is the base amount of federal taxes, 38%.
Mhm.
Then additional tax on the investment income. You're going to have the 10 2/3
Mhm.
on the investment income. How much exactly they saying the investment income was? The investment general rate, maximum deductions, federal abatement that much, general reduction is small business deduction rate is that much, Maximum deduction is that much. They don't say here on the investment income what's the additional. They just throw it. We haven't talked about the additional here on the slides, not yet. I went over the slides quickly. I didn't see this rate. That wasn't introduced to us yet. Okay, so we have to keep that in mind. That's gonna come later. So this one is our total, first total that we have, and then we're chasing the rest. Those are the deductions, total deductions, total tax owing, total deduction, total tax deduction, that will be our total tax deductions, and then we can see where we are. And federal tax payable for that year is that much, because it's coming from that number. Right, we have that our calculation. This is for this company, for this example. Now, what you can do at some point, you can get rid of this column, because this column, we don't need it anymore. Make sense? The only thing that we need is the general reduction rate. It will be the that will be the base amount. That will be the here. We can easily change it to base amount less minus the small business deduction amount. We don't need that 500,000, and minus the investment income. We don't even need the percentage anymore, because the percentage is on the other cell. The small business deduction, that will be the 500,000, which is given from the textbook. The federal abatement tax will be on the base rate, base amount. And on this one will be only on the investment income. And that will be our base amount. And here we go. We have our very nice, useful chart, which you can use further. Now, in this case here, the type of income, now the capital cost, if we see since we are the Canadian Control Private Corporation, first we're going to apply the 38% general rate, right? Then we're going to deduct the abatement. What was that abatement? 10% federal tax abatement on the base amount 10%. We're going to deduct that 10%. Then we're going to deduct the 90% of the small business deduction, and we're going to come up with the 9%. 9%, which amount will be taxable? That will be the first $500,000. Now the second 500,000, since our income is 1 million, on the second $500,000 will be the general rate minus the abatement minus the general reduction rate, which is 13. So we're going to apply 15%. And on the investment income only, we're going to apply 38 2/3.
Are these two same questions with different calculation method, or?
Yes, that's exactly the same question. So this way, so you come up with the starting with the base amount and come up with the percentage of the every single amount and calculating everything. On the other type of question, the second way you can do it is first since it's on the first 500,000 non-manufacturing business income, on the first, that will be our first amount that we're going to apply this, I don't like this format cells.
I prefer first method.
Yes,
Easier.
yes, I totally agree with you. It looks easier, the first method. The second method is a little bit more complicated. It seems like a little bit more complicated. But on the second one, we can do this. On the second one, we can manipulate it a little bit. That will be the general rate minus the abandonment minus the small business deduction equal to, well, actually we can leave those rates, you know, we can leave those rates and only we can deduct that part. So on the first 500, which is will be our case will be 500,000, which we're going to get it from here. What we can do is insert and
Internet connection is not
dropping.
so good.
Not so good. Is
Okay.
breaking. Is it is still breaking? Can you hear me, Yunji?
Yeah, I can hear you. Yeah.
Okay. Sorry. Yes, I was expecting this one to happen at some point. I don't know, for some reason, always having problem with when I'm doing any lectures here at home. Always there's a problem with internet. I don't know why. I still cannot figure out why. And it's not only with you. I'm sorry, I have to apologize for that. It's not only with you. So what we can do is on the small business deduction always will be 500,000.
Yeah, I
So
can
we
hear
can
you
leave.
well now. Yeah,
So
okay.
we can leave this 500,000 like this. Then the next one. Let's merge those one first. And let's go with on the next 500,000, which will be equal to this one minus the first 500,000. Our interest rate will be 15%, so here will be 9%. That will be 9% for us. Here will be 15%. And the last one will be on the general rate. Or here on the general rate will be 38 2/3 on the $100,000 on the investment income. For where that came from. Now the question is, why is 38 2/3? I guess that's how much is because it's given. Because it's just given.
Can we not go over this? Just stick with the first one, first method.
Yes. We can do that. We can do that. We can stick only with the first one. Yes, definitely. If the first method is easier for you, the first method is better. Right? You're just calculating one, calculating the other one, and doing the other one. Okay, we're not gonna do this. But we should get the same result, right? You know, we should be naturally we should receive the same result.
Okay.
Let's forget it. Okay, so that was with this one. Let's continue with the slides. Forget about those Excel stuff. Let's move back to slides. So on the computation of the net income, we have to reconcile the accounting income and convert it to the net income for tax purposes, which we're applying the rules that we apply for chapter, I believe chapter 6 or chapter 7. Remember that chart that we went over the last time with the questions, with the
Yeah.
calculation, right? That's what we have to do. We always have to do that. That's our first step, to convert accounting income into the taxable net income for tax purposes, right? Then on the then we're gonna, so here the slide's gonna go how to calculate this, how to compute that taxable income. Now, deductions not available for corporations. So if there's a deductions which are not available, that's the capital gain deduction, that's not available. Employee stock option deduction, that's not available. Lump sum payments, those are not available. Norton residency deductions and social assistance work and compensation, which are applicable for the individual, those are not applicable for corporations. Now, the deduction which are available for corporation, those will be the charitable donation. A deduction rather than a credit. So here you're getting directly deduction. Remember, in the individual, the charitable donation comes as a non-refundable tax credit.
Yeah, non-refundable tax credit.
Right? Where here is direct deduction. Do you make the difference between deduction and tax credit?
No, non-refundable tax credit meaning you need to add or
So it's a very significant difference. Deduction means you directly deducting door to door.
okay.
Credit means some amount is accumulated, and after that you're applying only percentage to that
I
amount.
can't hear you.
No? Hello? Let me try to refresh this Zoom, and sometimes that's when I refresh it, it helps.
It's cutting out.
Just a second. Refresh.
Yeah.
Can you hear me?
Yeah.
Okay. So yes, it cut me out, and now I'm back. So I hope
Hi.
this time will be a little bit better. Let's see how it goes. So the difference between the deduction and credit is, when you have deduction, you're deducting the entire amount, and you're getting door-to-door effect. For example, the example will be, let's say your income is $100.
Yes.
If you deduct $10, your income is going to be $90 now.
Yes.
Right? Now with the credit, you're going to add all those credits. Then you apply percentage. And that amount is going to deduct your taxable amount, the amount of the taxes that you owe. So basically, you're not getting reduction for the taxable, the amount before they apply the taxes. You're just getting credit that reducing the amount that you have to pay later. Make sense?
Kind of.
So watch this. Imagine your taxes, you come up with the taxes, your income is $100.
Yes.
Government give you deduction to deduct, let's say, retirement saving plans, registered retirement saving plans. The reduction you have, the reduction $10. So now the taxable income, the income that you have to apply taxes, become $90.
Yes.
You're calculating the taxes. Let's say the taxes come up with $10. You come up with taxes, you have to pay $10 to the government. Instead of, if it was your income 100, you have to pay, let's say, $15. Now you have to pay only $10. Now, at that point, once you come up with the $10 that you have to, the tax owing, you don't have to pay yet. Then you're coming another calculation which gonna calculate, is there anything that you can do to reduce those $10?
Mm.
Those credits gonna apply to the $10,
Oh, okay.
right?
Mm-hmm.
So now you see the difference. Deduct the taxable, the amount before you apply the taxes, where the
Mm-hmm.
credit applies to the amount that you're owing.
Okay.
Make sense?
Yeah, makes sense.
So do you see the difference? So
Yeah.
generally you prefer to have a deduction rather than credit.
Mm.
The effect of the deduction will be far more greater than you only have a credit, certain percentage.
Mm-hmm.
So on the charitable donation, now that's deduction. So directly deduct the income,
Mm-hmm.
and you can carry it forward for 5 years.
Oh, okay.
On the dividend
Mm-hmm.
for the corporation, there's no gross up,
Oh.
and also permitted to deduct the full amount of the taxable dividend received from the taxable Canadian corporation. So basically, dividend flows from one corporation to another corporation tax-free.
Mm-hmm.
Once one corporation paid the taxes on the income, and then moving the dividend from one company to another company, no taxes anymore.
Mm-hmm. Okay.
Okay, so now with the computation with the taxes. Now, we have to convert the corporate net income for the taxable income.
Mm-hmm.
Let's say we have the net income loss. We're gonna go with the less charitable donation, which are limited to 75% of the net income, with carry forward 75%, 70 over 5 years. You can carry it forward. If you don't use it this year, you can carry it forward for 5 years.
Mm-hmm.
The taxable dividend which is received,
Mm-hmm.
and then you can loss carry over from the subsequent or prior year. So basically, you can carry forward that loss, and then you come up with the taxable income,
Mm-hmm.
right? So again, you're having your net income starting point,
Mm-hmm.
deducting the charitable donation,
Mm-hmm.
deducting the dividend received,
Mm-hmm.
and deducting the loss carry over from the subsequent or prior years, and then you come up with the taxable income.
Okay.
So here explained about taxable dividend from Canadian corporation that flows free, and this is the logic here. Assuming that corporation tax rate is 30% deduction, so basically A, B, and C company, the tax rate will be taxable dividend, taxable corporation. Assuming the corporate rate is deduction, not apply. And you can see how the amount from 1,000 going down to 49. From one corporation to another corporation to another corporation. Now the problem is that 51% tax rate is not consistent with the integration. So what will be the solution? Allow corporation to deduct taxable dividend received from other taxable Canadian corporations.
Mm-hmm.
Right? For that reason, that's the general idea here, because for that reason, the dividend flows from one corporation to another corporation tax-free.
Yeah.
Dividend stop loss rule. What will be that? The scenario, let's acquire shares at $10, receive $1 dividend, and sell the shares for $9 on July for a capital loss. Now the anti-avoidance stop loss rule will be applied for that will disallow the capital loss. Right, the capital loss that you're showing, that will be disallowed. Since the shares are owned less than 1 year, and taxpayer own more than 5% on any class of the shares or corporation, then pay the dividend. I don't think anything like that's gonna come on the exam because this is a very specific thing on the dividend. I don't see anything coming on this case.
Right.
So let's talk about net capital loss carry over for the corporation. So the company has the business loss.
Mm-hmm.
They receive dividend.
Mm-hmm.
They have bond investment interest. IBIL. Where did it come from? Did we see somewhere IBIL before? So one place to see it. Where is the other place to see it? Business loss in. What is IBIL? That's what I'm telling you. I hate the abbreviation.
Business something loss.
Allowable business investment capital loss.
Oh, okay.
Allowable business investment loss.
Mm-hmm.
That's what is it.
Mm-hmm.
Let me copy it. So the business investment losses. Allowable business investment loss, IBL. Allowable business investment loss, IBL.
Okay.
Can you hear me?
Yeah.
Okay.
Net income and taxable income.
So let's put it here
Mm-hmm.
and plug it. Allowable business investment loss.
Mm-hmm.
So we have the bond interest, allowable business investment loss. Then we have the taxable capital gain, allowable capital losses, and available from the previous year's net capital loss carry forwards will be $8,000. So dividend received, we're gonna add it. The bond gonna add it. The allowable business loss, we're gonna deduct it. So let's see what will be the here dividend in interest, which is 10 plus 5 will be 15. Next net taxable gain, which will be 15 minus 7 net
Mm-hmm.
taxable gain. Then we're going to have from those two, we're going to have 23. Business loss, we have the 60 plus the allowable business investment loss 3, that's 63.
Mm-hmm.
That will be net income for tax purposes. Net income and taxable income will be 0. It cannot be below, right? So available for the previous year, net capital loss carry forward 8,000. That's gonna keep carry forward. The observation of the dividend, the 10,000 is not taxable, and there are sufficient net taxable capital gain to deduct any carry forward loss with 8,000. This is the $8,000. So what's gonna happen here? The formula: 60,000 business loss. We adding the net capital loss, which is carry forward 8,000. We adding this allowable business investment loss 3,000, and we deducting the dividend. So we have loss available 81. We deducting the 23,000, which was the 23,000 come from the dividend and interest, plus the net taxable capital gain. We deducting the 23, and we have the net capital loss is $58,000. And that amount we can carry forward. Does that makes any sense?
Yeah, non-capital loss. Do we need to calculate so we're calculating non-capital loss.
Non-capital loss, yes.
Mm. Mm-hmm.
Because
Okay, that's how you
we
calculate.
yeah, but we have to we're trying to, because the capital loss is different. The capital loss can be only applied to the capital gain, right?
Mm-hmm. Mm-hmm.
Because they're in the reality of the 50%.
Oh, these are non-capital loss. That's why
Right.
they're called as. I
That's why
see.
that's why it's different calculation, right?
Oh, okay. Mm.
For that reason, that's why we're deducting here the net capital loss. We getting the net capital loss, which is on the taxable capital gain and allowable
Yeah.
capital losses, right?
Mm-hmm. Mm-hmm.
That will be, now we're gonna have available, that net taxable gain is 5.
Yeah.
Allowable capital losses is 7.
Yeah.
And allowable from the previous net capital loss carry forward 8.
Mm-hmm.
And here we're going to have the capital gain,
Mm-hmm.
8,000,
Mm-hmm.
in total 23. So here we're going to get now we're going to start calculating this, guys. Now this taxable capital gain, 8,000, with this 8,000, they're going to eliminate each other, right?
Mm-hmm.
Because here we have 8,000 net capital, taxable capital gain 8,000.
Yeah.
But we have carry forward
It's
loss,
forward, yeah.
right?
Okay. That will
Right.
0. Okay.
So for that reason, we have the sufficient net taxable gain to deduct the carry forward loss at 8,000.
Oh,
So
I see.
if we, so for example, if this was like a 10, let's say
Yeah.
here 10, then we're going to have here, what will be that? That will be 3,000.
Yeah.
3,000. In this 3,000, we cannot deduct the entire capital gain, capital loss carry forward. We can deduct only 3,000.
Okay.
Then the 5,000 capital gain is going to keep carry forward.
Oh, okay.
Make sense?
Yeah, makes sense.
Right? Don't try to look at those capital gain versus non-capital separately. Because the capital, everything when you see capital, that exists on the 50% reality. Everything else is on the 100%. That's the thing that I want you to remember. This one is interesting. Geographical allocation of income. When you have the permanent establishment, where the taxable income here is allocated to determine the amount of provincial territorial taxes, which is payable. Here we're going to have activity income allocated on 2 variables: gross revenue attributable to the PE will be permanent establishment. So that will be the gross revenue attributable to the permanent establishment, and salary wages paid by the corporation to employee of the permanent establishment. Let's see what will be the example here. Let's say the gross revenue of Alberta, 25,000, 250,000. Manitoba, 400,000. Ontario, 400,000. The percentages, that's how those percentages are, right? Because the 1 million is 100%. Then we come up with the percentage of the every single territory. Now the tax rate, salary, now the geographical location, still example. Now the salaries and wages, that's how they're coming. Now, how that's going to be allocated by the province? That's interesting thing. Let's have you seen this before?
No, no.
No. Let's flip it on the Excel and let's use
I don't think that this will come up on the Excel.
you know what? I have seen questions with this.
Oh, okay.
Because the only reason that they're throwing these questions is because of the location, and it's not that complicated.
Okay.
This question is not that complicated. The logic
All
is
right.
very simple. It's very simple logic, and they might throw something like this now. Because again, if you haven't seen any, that doesn't mean that it's not gonna come.
Okay.
That's the catch.
Mm,
And again, this is a very, very, very simple. Nothing scary here.
okay.
So the allocation of the provinces, and I'm gonna give you this one later. I'm gonna give you the Excel spreadsheet anyway. See how they come up with the amount allocated. The whole point is you to come up with the amount allocated, because in different provinces, you're gonna pay different percentages, right?
Mm-hmm.
So when we put it on the Excel spreadsheet, it's gonna look like this. Let me share it, share. That's how it's gonna look like. So Alberta, you have on the gross revenue, 250 here. Salaries and wages, 100.
Mm-hmm.
Manitoba, you have 400 revenue. Salaries, wages, 200. Ontario, you have 350. Salaries and wages, that much. Now, how we gonna allocate taxable income? Taxable income is 100,000, which is 100,000.
Mm-hmm.
Now, how we gonna allocate that income based on the different provinces that we have and based on the different percentages that we have in those provinces? Now, where they get this average revenue and salary wages percentage for each province? Forty.
Where do you get
So,
the average?
the average, watch this, the average is equal to average of this one
Mm-hmm.
and that one.
Oh.
Why no? Sorry. Let's average of just those two numbers. How can we get the average of this number? Number one and number two. And we come up with the percentage.
Mm.
Make sense?
Yeah.
So the average here will be the same.
Mm.
I can easily drag it down, it's gonna get the same.
Mm-hmm.
And the
Mm-hmm.
total should be 100%.
I see. Okay.
Right?
Average. Yeah.
And
So,
then if the taxable income is only $100,000, how are we gonna allocate it that amount to each province? Because on each province, you're gonna have a different federal tax level, tax rate.
Mm-hmm. I see. I understand.
Right?
Yeah. Mm-hmm.
It's super easy. It's super
Yeah.
easy, and technically, it's crying to somebody to ask you multiple choice question on this.
Yeah, it is.
Right? It seems like a super scary, but when
Mm.
you pay a little bit more attention, It's not. So the federal, again, here we're going with the basic rate, which is 38. Federal tax amendment, 10% reduction of federal income tax rate. This is only applicable the income which is earned in the province or territory.
Okay.
Otherwise it will be
Mhm.
reduced.
All
That
right.
means if it comes from somewhere other country, it's not going to work.
Okay.
General rate reduction, 13%, full rate
Mhm.
taxable on the full rate taxable income.
Mhm.
So where the federal tax rate, so we going to get the 38%. We're going to deduct the federal tax amendment,
Mhm.
10%. Then we're going to deduct the general rate reduction, 30%, and the general federal corporation tax rate is 15%.
I see.
Now, the province and territories is a different story, but we don't care about that.
Mhm.
Small business, now the provincial territorial tax payables, we're going to have here the manufacturing and processing income eligible, which is for 30% deduction.
Mhm.
General rate reduction provides same 30% reduction. However, manufacturing and processing deduction claim no, if you claim that one, there will be no general rate reduction. Only Ontario, Yukon, and Saskatchewan apply additional manufacturing and processing rate reduction that generally rely on the federal calculation. And the small business deductions, again, the federal tax rate reduction is 9% on the first $500,000. And this only on the active business income. So you have to look at the question, how much is the active business income? If the active business income is more than $500,000, let's say the active business income is $600,000, you don't have to worry about it, right? Because it's more than $500,000. You're going to apply the small business deduction to first $500,000 anyway.
I see.
Right? The same thing that we did it on the question, because the active business income was $900,000. But if the question says that the active business income, the total income is $700,000, but active business income is $400,000, then the small business deduction rate we're going to apply only on the $400,000. Make sense? That's
Okay,
where
so
that's where the catch is.
mm,
So you have to read the question very carefully. Now, all provinces don't apply the small business rate reduction on the first $500. Saskatchewan, 600,000, but since we're not in Saskatchewan, we don't have to worry about this.
so I guess maximum is 500,000.
500,000, that's how we're gonna remember it.
Okay.
So other goals on the corporate to incentive for the small business. So obviously we want to encourage the small businesses by giving the small business deductions. We're going to incentive for the tax credit on the scientific research. If you go into that direction, there will be more deductions. And all those things. Now the small business deduction. The small business deduction, provincially policy goals, small business deduction. So the small business deduction business is lowering tax rate on the business income. So basically give them less tax on the small business notion and reinvestment notion. Let's forget about those one. Let's see this. Canadian Control Private Corporation with $100,000 taxable income. All income is earned in Canada, and everything is eligible for small business deductions. Now the question is, what will be the rate that's going to apply? Well, 38%, no questions about it. They're going to apply that federal tax amendment 10%. Then they're going to apply the small business deduction 19%.
Oh, okay.
Right. And then we're going to come up with the federal income tax payable.
Mm-hmm.
Provincial tax payable, 2% we're going to add, and then going to end up with paying 11% taxes, which is not bad. 11% taxes, that's nothing. I wish we paid that much. So which are the Canadian control? Now the definition here is which are controlled. Those are private company incorporated and resident in Canada, cannot be controlled by public corporation or non-resident. So every time when you have an international student on the Canadian corporation, that doesn't qualify for Canadian control private corporation. Make sense? Did you hear me?
No.
If you have an international student
Yes.
as a owner of the corporation, that's not going to qualify for the Canadian control private corporation.
Oh, okay.
Right? And also cannot share Canadian control cannot be listed on designated stock exchange in Canada.
Okay.
So basically no trades here.
Right.
Substantive, those will be are charged additional 10.2 of most type of investment income. So if this company have investment income, 10.2 gonna apply.
Okay.
So active, now we're going to the active business income. Now the active business income excludes business that earn investment type income, and also includes also represent a corporation acting as a intermediary between the employer and employee. If the company dealing with the employee and is a mediator, that doesn't that not qualify for the active business income. Include incidental income that is connected to the active businesses, interest earned on account receivables. So interest earned on account receivable, that's count for the active business income. Right? It's not income from investment.
Oh, okay.
Make sense?
Makes sense. Yeah.
Right. The problem with defining the property income is the interest and rental income may be the product of the active income. When that's going to happen? If we have, listen, if we have a bank institution, what's the source of income for the bank? Interest.
Interest, yeah.
Well, in that case, that will become an active business income. Right? Because that's the main source of the revenue. Bank services is based on the interest, just to generate interest. Same thing with the rental income. If we have a property management who managing the building, which building is for the rental purposes only, that's become a business income. So the solution, those specified investment businesses those do not get specified investment businesses do not get small business deduction. Obviously, there are exceptions. If the Canadian Control Private Corporation employs more than 5 full-time employees, or any other corporation associated with the small business corporation provides while carry active business, managerial, or similar services to. So specified investment business do not get this business. So employee more than 5 full-time employee exception, and any other corporation associated with the while carrying an active business, managerial similar services to the Canadian Control Privacy, and the Canadian would reasonably be expected to employ more than 5 full-time employees, so if that service was not provided. And there's some more on the property income received from the associated corporations. Those are treated as an active business income, not property income. The annual limit is $500,000. Now, tricky part here is, as you can see, the associated company, they sharing those one. Okay. If we have
Mhm.
associated companies, so now the question is which company are associated,
If you are doing business
right?
or shares, yeah.
Right, that will be the question, right? Since we associated company has to share the question, the next question is which are the company which are associated. So if the one shareholder is one of the owners have two companies, obviously those. If one company owns the other company, those associated company, they have to share the $500,000 business limit.
Okay.
Right, there's a limited reduce for the taxable so limit reduces the for the Canadian Control Private Corporation with either. This one is very important because this one comes. I have seen this one.
Oh.
Taxable capital employed in Canada in excess of 10 million in the preceding year, or adjustable aggregate investment income. Now we have to get those abbreviation, because those is going to start playing in our calculations, right? I'm going to put those abbreviation because those are even for me. There's so many abbreviations, and in the questions, when you see questions, they're assuming that you know those abbreviations. So let's pull this one, the entire thing, and I'm gonna put it somewhere on the Excel, and once we come back to that Excel, we're gonna see what's that. Hold on. Now the calculation of the small business deduction. Now the general formula is 90% of the list of non-Canadian.
I can't hear you well.
No? Okay, so let me try to refresh it again. Let's see if I can refresh quickly. How is now? Any better?
Yeah.
Okay, so let's go here. Now the calculating of the small business deduction. Not the taxes, the small business deductions. So they specify that the small business deduction as 90% is 90% of list of net Canadian active income. So now we have to chase the net Canadian active income. That's one thing that we have to chase. B, taxable income less. That's crazy formula. $100 divided by 28 of time credit of foreign taxes paid and the foreign non-business income tax calculated without consideration of general rate reduction. RT beat me. I don't know what is that. I should be somewhere. Let's forget about it. And 4 time credit paid to foreign business calculated without consideration general rate reduction. Or C is what it's C go is the annual business limit, 500,000 less any portion. So this one is tricky one as well. Less any portion of allocated to associated corporation, less any reduction of the taxable capital employed in Canada, and or adjusted aggregate investment income. That's why those things now start playing a kind of big time in the calculation on the small business deductions only. It's only available of the net active business income earned in Canada. Corporation carrying 2 or more active businesses in a year, then they have to share that. small business deduction. Net active
Mm-hmm.
business income equal to the income on one active business minus the losses of the other active business. The business limit of 500,000 or lesser allocated amount was associated to the corporation. Business limit is reduced by amount relating to that taxable capital employed in Canada and adjusted aggregate investment income. Let me see if they give you some the constraints of the taxable income, charitable donation. Let me see if is there any example. I want to see if there's an example here rather than just speaking. Problem one, problem two. Let's see the problem one. Business limit reduction intended to the small business deduction. Provide tax advantages to the small business sizes not large. Reduction applied to grind down the business income taxable. Problem two, low small business rate provides. Okay. Reduction.
Kind of, yeah.
This is when, so the corporation business limit for the year, 500,000 or less if shared with the associate company. Then we gonna, B is 0.225 in excess of the, what was that, TCA grind. Greater of the C grind, and so TCCA is, where can I find it? Let me see. I found it. That will be the taxable capital employed in Canada.
Mm.
Right? The taxable capital employed in Canada. Over $10 million in the previous year. When this taxable capital employed in Canada is below or equal to 10 million, there will be no reduction of the small business limit. When the taxable capital employed in Canada is between 10 million and 15 million, then will be proportional reduction of the small business limit. So basically, they don't give a small business deduction for the corporation that have high, more than 10 million taxable capital employed in Canada. Make sense?
Mm-hmm.
Because they don't qualify for the small business. That's already big business. Anything that have capital employed in Canada more than 10 million, they become they're not small. And
Okay.
as you can see here, when that capital employed in Canada is equal to $15 million or higher,
Mm-hmm.
you're not getting any small business deductions anymore.
Mm-hmm.
Make sense?
Makes sense.
So that's why some of the questions, what they're doing is they're telling you that how much is the income, and then they're telling you the taxable capital employed in Canada is $12 million.
Mm-hmm.
So that up to $10 million, there will be no deduction, but the additional $2 million, they're going to trigger some deduction of the small business. And how much will be that? The deduction will be proportionate of how much is it? Let's say 12 million minus 10 million times 0.02225.
Mm-hmm.
And that will be the reduction of the small business deductions. Now we're going to the other one, which is the adjustable aggregate investment income, which comes, in simplified terms, that the income from the property, net taxable capital gain, and dividend received for the taxable Canadian corporation and foreign corporation, or income from the specified investment businesses. Here the reduction is, also here, that also apply for the reduction. Reduction is, the D is the corporation annual business limit for the year. So 500,000 divided by 500,000 times 5 times E is the total adjusted aggregate investment income minus 50,000. Again, crazy calculation.
Mhm.
I'm trying to personal service businesses, the outcome, professional corporation management companies. I'm trying to find something which we can apply all those things so we can see the actual application, but I don't see any questions here. So here we're going with the manufacturing processing profit deduction. That is 13% of the lesser of. So now we have to chase which one is the lesser. The manufacturing processing profits less the amount of the eligible small business deduction. So on the small business deduction, you cannot apply 13% because you're already applying the higher 19%. Only on everything above, if you qualify here, you're going to apply 13%. But if it doesn't qualify for the manufacturing processing, you're going to apply the general reduction rate,
Okay.
which is
Yeah.
also 13%, right? So that 13% always going to come to you either as a general reduction rate, either as a manufacturing processing.
Okay.
That's some constraints here. So the 13% of the full rate taxable income, that's a general reduction rate. So we're going to get this regular taxable income. We're going to deduct the income eligible for the manufacturing processing deduction. And then we're going to get the full rate taxable income. What will be that? The fact, the year end ending December 31st, this company, Canadian Control, have the taxable income, $100,000, with 40,000 eligible to manufacturing processing. So what we're going to do? We're going to get 38% on the full amount, on the 100,000. Then we're going to deduct the tax
Federal.
abandonment.
Okay.
Then we're going to apply the small business deduction, but only on the portion which is not eligible for the manufacturing processing. No, actually, that's not small business deduction. My bad. This is the general rate reduction.
Yeah.
So you see the in technically in the entire 100,000 amount, you're applying the 13%. But 13% come with the manufacturing processing, the other 13% come with the general reduction rate.
I see.
But regardless, you're getting 13,000.
Understand.
All right. So as you can see, this company here is Canadian company. It's not Canadian Control Private Corporation.
Oh.
That's why the small business deduction here don't apply.
Oh, okay.
Right?
Oh,
So,
I see.
so
Small business only for CCPC.
So only Canadian Control Private Corporation, which qualify.
Okay.
Right? Because if the taxable capital employed in Canada is more than $50 million, there will be nothing there for them.
Okay.
Right? So general reduction rate, which is for the Canadian Control Private Corporation, full rate again apply, and this will be the calculation now. So let's see the fact. This company now the company is Canadian Control Private Corporation, which has a taxable income of $200,000, but they're associated with another company, and the other company earned $100,000 of the 500. So since both companies together not exceed $500,000, both company can enjoy the small business deduction. Make sense? So how are we going to do it? We're going to get the base rate, 38%, no questions about it. we're gonna apply the abatement 10%. We're gonna apply the entire small business deduction 90 on the 100,000 because the other company has taxable income 200,000. Is associated with another company is entitled to 100,000 of the 500,000. So 100,000. So because they're associated with another company is entitled to 100,000 of the $500,000. Why they deducting $100,000 here?
I don't know.
That's my question too. Why the small business deduction doesn't apply? Because they're not exceeding $500,000 altogether. Maybe we're not reading the question. Entitled to 100,000 of 500 business limit. Okay. So we're not reading the question correctly. It doesn't. It's associated with another company, but our company can deduct only 100,000 out of 500,000. Right. So technically the other company with associated company, and that company has, what is that? $400,000 in.
Oh, okay.
Right. So then the Zemptech will be entitled only $100,000. Because with another company, that company has that much taxable income, 400 taxable income. Now it's more clear, right? We're assuming that the other company has 100, but they're not having 100. They're having our company is entitled only to 100 out of 500. So that means the other company has a 400,000 taxable income. Right? So that's why now the calculation makes sense. That's why we're deducting 19% only on the $100,000, which you're applying for this company. But now, once we moved to the next, then we have the available general reduction rate. So we're not completely out of deductions here. Yes, we're not going to get the 19%, but we're going to get 13%. We're losing only 6%. And then we come up with the federal taxable payable of $24,000. This is for the foreign business. I don't think the foreign business is going to come. So the foreign businesses, let's leave it. So this is the very interesting thing, which I want you to understand as well. Base rate apply for both business or non-business. Federal abatement. Abatement for the, what was that? Division B, which is this the foreign business and non-foreign business. Is that how it is? Tax otherwise payable component, non-business business. It's not clear for which one apply. Is this for the foreign businesses or for the general businesses? Probably it's the foreign businesses because the foreign tax credits. Everything is on the foreign tax credit. So, okay, generally labor tax credit, that's something very specific. That's the end. That's the end of this. It's a crazy, but at least we have some ideas what's going on, right?
Yes, yeah, I do. Like the GRR and small business deduction. Yeah.
Right.
Yeah. When to apply.
All right. So what we can do here is the only thing that left to do is to get the abbreviation.
Abbreviation, yeah.
Abbreviation. Get the abbreviation.
Yeah.
Get comfortable with the abbreviation. general reduction rate, manufacturing
Right.
processing cost, small business deduction, because in the question is going to be CBD and something like that. And if they
Okay.
throw you this term AALL, no AAII, adjusted
Yeah.
aggregate investment income, and you're going to say, what are you talking about now?
Right.
Or if they put a TCEC, Toronto Capital Exchange Commission, right?
Right.
Which actually is taxable capital employed in Canada,
Yeah.
and that also applies for our calculation, the small business deductions. I'll encourage you to go over some questions which require a little bit calculation like this to
Yeah.
see application of this this string taxable capital employed in Canada and
Okay.
adjusted
Here.
aggregate. Sorry? Hello? Hello? Can you hear me? Hello?
Yeah, I can hear you now. Yeah.
Okay.
Hello.
Hello?
Yeah.
Yeah. I'm hearing you. Okay.
All right.
Sorry
Yeah.
about
It's okay. I
sorry
got
about
some
the internet
ideas.
connection, but at least
Yeah.
the recording keep going.
Oh, okay, that's great. Yeah.
So I hope the recording catch everything,
Yes, I hope so. I think it did.
right? But you're
Yeah.
gonna